Welcome back. Stocks are having their worst week since the financial crisis, with the Dow on pace to lose about 4,000 points in the biggest weekly points drop ever. The Dow right now down about 2.3% or 582 points. The S&P a little bit less than that, 1.7%, and the Nasdaq only down 1%. Meanwhile, the yield on the 10-year hitting fresh record lows today, especially earlier today. You can see it there, the latest about 1.144%. So it does just continue to keep sliding. And Fed Chair Jay Powell putting out a statement just about 20 minutes ago saying the fundamentals of the U.S. economy remain strong. But, and this is where investors pay attention, he says the Fed is closely monitoring the coronavirus situation and will act appropriately. Let's bring in Lee Munson, Chief Investment Officer with Portfolio Asset Management, and rejoining us is CNBC contributor Ron Insana. Ron, you were with us when this Fed statement crossed about a half an hour ago. The initial market reaction looked either disappointed or unbothered completely by it. Now it might look a little bit better, but perhaps we're parsing this too finely here. Well,
and it's hard to tell, Kelly. You know, I think in a strange sense, going back to my earlier days of covering stuff like this, if the Fed had come out after the close, they would have set up Monday as a day in which the market could rally. And this is really kind of tactical stuff from a policy perspective. Whereas now, if the market sells off into the close after the Fed said something like that,
they've already wasted that bullet.
They've wasted that bullet, and there'd be a belief that, and maybe rightly so, that a rate cut is not going to cure this problem.
If they had done it after the close, would that have just given people all weekend to make the same arguments that we were making in
possibly? Yeah,
time about whether it was enough?
It is a double-edged sword, and the Fed will get either praise or blame for just about anything they do at this juncture. But the fundamental issue is again still not monetary policy. It's how deep is the economic impact in China, globally, and here in the United States. How much does it reduce corporate profits in the first 2 quarters of the year? And would lower rates cushion any kind of blow you might see from the economic and business impact?
Lee, you want to weigh in on that?
Yeah, I do. I've been doing this for 22 years. And last night, I really felt a change of heart that I hadn't felt since September 2008 when Lehman failed. I'm generally a person who likes to come in early on corrections. We've been buyers of the S&P, a little bit emerging markets all week. But once I started looking at the information from the CDC, and also I've got a lot of clients, we're out here in New Mexico, and I have clients that work at the labs that work in risk assessment and, nuclear deterrence. And what I'm hearing on that side is that we're going to get some more information in the next couple of days from the CDC. But the bottom line is, in order for this administration to get elected again, if that's their intention, they're going to have to control behavior. And when I hear that, I'm not concerned about death tolls. I'm not concerned about this going past summer. What I'm concerned about is that we're going to have school closures here. And if that starts to mute consumer spending, let's be honest. The U.S. consumer, it's what's keeping this global thing going. And even if ours get cut, it's going to be a problem. So I am not usually buying. I'm usually buying today, and I'm not today.
So let me ask you, even if we play out that kind of worst case scenario, take it to its logical conclusion. So there's school closures, there's event cancellations. This lasts for a period of some time. How are we talking about an actual recession? If so, how deep? And if so, how long? Because all of those pieces of speculation factor into what the market will do. There's a big difference between, hey, this is going to be slower growth for a little while, and this is going to be a sharper downturn, and the nature of a rebound that we might then get following it, whatever that rebound might look like.
Oh, yeah. I mean, all this week I've been spouting out a V-shaped recovery. So I'm not, by the way, I am still a bull. So let's just make sure that auto bull got told. But what I do think is I think the psychological toll is going to be much greater than necessarily the economic toll. I don't think that we're going to be in a recession. I don't think we're going to see more than maybe 15, 20, maybe 25% profits not coming in as we expected. But if you just have several months where there's less activity, people are not going out to eat, doing that, I think the psychological toll means that as we get closer to a 20% correction, which is only about another 100, 150 points from here, I think we go lower. More specifically, for all those technicians out there, we never got a retest of that December Christmas Eve 2018 low at 2350. I think that we're going to see a retest that would just move us back 14 months. But the bottom line is I don't see a severe recession, but I see a very much more severe reaction over the coming months. And that's why this bull wants to reduce some exposure in Europe, in Japan. But I'm not selling my S&P, but I am selling some small cap values, some other places. I'm doing silly things like buying some gold and short-term treasuries right now. I haven't done that since Lehman, and I think that's significant to have that type of change of heart just in 24 hours.
Ron, what I guess it's debatable what a rate cut would do for the economy. What would it do for the stock market? And for oil.
Again, one would assume, and for all intents and purposes, Jay Powell just hinted that if necessary, the Fed will cut rates, and we've had virtually no meaningful response from the equity market. It's not like at the moment we're not looking at, a rally that is going to take us higher at the close. Where I would part ways, I think, with Lee is that, look, 2008 was a unique event insofar as it was a global systemic financial crisis. That's not what we have. Banks have capital. They have liquidity. This is not a money problem of sorts. It is a economic disruption. And I agree, we might have a 2, 3, 6 month constraint on profits and growth, but we're in a year in which we're likely only to grow 2 or 2.5% anyway. So it's not like you're going to get some 5% updraft on the other side. Not here, not in China, not in Germany, not in Italy, not in Japan, not in South Korea. Japan, in fact, even before coronavirus, had a 6% contraction in its economy for putting on a national sales tax when the economy wasn't that strong. So I think you get, a longer period of slower growth. Even if you don't get a recession.
Real quickly, what do you make? We are seeing the dollar slide a little bit since Powell spoke. Treasury yields are falling, and that's helping kind of just shore up a teensy bit the action in gold and in some of the commodities. Is that more significant to you in the days ahead, do you think, or no?
Well, I think gold has been hurt by forced selling. Because, again, if there are margin calls and other levered players who are trying to raise cash, gold's been up a lot, so they may be taking profits there. What strikes me more is a 114 print on the 10-year note. The note continues to fall in yield, even as the stock market tries to recover. So clearly, now they're pricing in a rate cut. Now they're pricing in slower growth, even more dramatically than they had earlier in the day. So, that's not my favorite message out of the markets right now, with bond yields continuing to fall. That tells me, and with oil dropping still, that there's demand destruction expected ahead.
All right, Ron Insana, Lee Munson, thank you both.